How are we doing, everybody? Welcome to this next section, which is going to be on reading fractal structure and lower time frame order flow. So we've learned about ranges within the market. We've learned how we use them in regards to order flow, but what we need to understand is how we can use them in regards to structure. So what we've learned so far is that we understand we've got higher time frame swings and lower time frame swings, and these swing structures build the market that we see. And we understand we use our time frames to be able to read the swings within the market. We understand that there's not a swing specific to a specific time frame, for example. We understand we use time frames to read the structure within the market, and we understand the intentions across multi-time frame to understand whether we're bullish on one swing, bearish on another swing. We build a story and a narrative depending on the intentions that we see. We understand protected and weak levels, and then from that, what we understand then is that we can understand where we're positioned and where we can expect to see price next. Now, the ranges that we use in regards to structure are so important to really level up our trading from a higher time frame structural perspective and also an entry perspective, because we can understand and use ranges to potentially understand when we've got alignment in the market, when we've had potential weak highs and lows being put into the market, when we can potentially see a low get ran. These ranges are so important to understand from a structural perspective, not just order flow. We understand order flow is lower time frame swing structure or lower time frame structure, but what we understand is when we utilize these ranges and understand to see structure in regards to ranges, it really helps to level up our trading. Now, in the diagram that we can see on the screen, we've talked about before how we have multiple levels of swing structure, okay? And these ranges that we can see are higher time frame swings and lower time frame swings. Now, we use supply ranges and demand ranges, which we've already identified how to draw them out as a valid level, which if you go back into the market structure section and you rewatch the ranges and order flow, you'll learn how we draw on and identify these ranges on the charts. We have supply levels, ranges and demand ranges, okay? So when we break the low of a range, we put in a new supply range, and when we break the high of a range, we put in a new demand range. Now, think about this for a minute. We understand when we've got supply and demand ranges, we understand that, for example, when we've got supply ranges, we are bearish, and when we've got demand ranges, we are bullish. And this is where we can piece together and visually see and understand when we've got structure ranges all aligned in our favor. This can tell us how we are aligned in the market, where we could potentially be seeing pricing heading next. And it's so important to understand these structural ranges, not just from lower time frame order flow, but it's good to be able to understand and read structure to that next level to understand when we've had alignment. So what we can see now in this diagram that we can see here is we've got pieced together, it's going to be one overall structure, and then it's got the higher time frame and lower time frame structure within it. So if we have a look here and we think, for example, now the larger, bigger picture is the 4 hour. Okay, so we've got the higher high, the higher low, the higher high, the higher low, and the higher high. Okay, so we understand from this high all the way to this low down here, and then once we've had the breaker structure where we've put in a new higher high, we've now formed a new higher time frame demand range. So that means we're bullish because we've put in a new demand range. And then what we can see here now, as we put in this new higher high, when we start seeing supply ranges being put into the market, when we've come up to the top here, so let's just say, for example, now we put in a supply range up in here, we got a quick change of character, then we've broken down and we start to see these supply ranges being put into the market. This now signifies we've shifted bearish. So now that we're starting to put in supply ranges within an overall bullish demand range, this is signifying to us now that we're putting in our complex pullback, because supply ranges is bearish structure and the demand ranges are bullish structure. So this is how we can see a visual representation of what we can see going on in the market. So within this, for example, when we see the complex pullback, we'll just take it back to here for a minute. We can see that we had this higher high, higher low, higher high. That has signified a 4 hour, for example, breaker structure. Now, internally within this, we can see that we're bearish and we start to put in these new supply ranges, being these internal breaks of structures, because we understand we're contained within an overall swing structure, being this high to this low. And then what can we see? We've had an internal breaker structure bearish, and we've had an internal structure break bullish. Okay, so what does this signify and what does this mean? So when we see this now, when we look at things from a structural understanding, we can see we've had a breaker structure bearish and an internal structure break bullish. So an internal structural break bullish creates a new demand range. Okay, that is contained also within a demand range. So now we've gone from a supply range to a demand range internally, whilst also having bullish swing structure forming this demand range here, and then following this this breaker structure here creates this higher time frame demand range right here. And it's the same thing that goes here. When we've had this high to this low, when we've put in a new higher high on the higher time frame, this creates a whole new larger demand range from this high to this low to this high, okay? And then we need to be able to understand and look internally to be able to see what the ranges are saying, which is this lower time frame structure. So as we can see here now, and the reason why we talk about using our time frames is so important, and why we really emphasize using the H1, for example, which is something that not a lot of people have done before. If we have a look at this example right here, we can see we've had this higher high, higher low, higher high, okay? We understand when we've got bullish market structure, we understand that what is the expectation of bullish market structure? It's to see a new higher low before a new higher high, okay? That is the expectation of bullish market structure. So we understand following this breaker structure right here, we've put in a new protected low on the higher time frame, and this being the week high. This is basic structure that we've learned before. And then we can see here now that internally we're putting in these larger supply ranges, which might be the H1 structure. And then for example here now, if we draw on a demand level here, okay, what we need to understand is, even though we've had a mitigation to demand here, for example, and we see on a lower time frame such as the 15-minute, we see the low go and then the high go, and if we just zoom in, we can see we've gone from a supply range to a demand range. We need to understand and look internally. What can we see? Okay, and this is where this whole thing about when you have M15 and H4 aligned, this is why it's more important to be able to see further than that, because even so, if this was a H4 bullish structure and then this was a 15-minute breaker structure, this does not confirm to us that we can target this as our high unless we mitigate an extreme, which I'll go over in a minute. But we cannot target to come and take this just yet with full confirmation, because we are still contained within an overall bearish swing structure internally and contained within this whole overall supply range. Okay, so we can see lower low, lower high, lower low. This is an internal breaker structure. This is still protected. This is weak, okay? Internally, we're still contained within a larger demand range, supply range. So when we have this take the low and we take the high right here, we can see now that we've had that shift on a lower time frame. But if we have a look internally, we can see we have this larger supply range, which indicates we're bearish internally, and then this break here where we take the low and we take the high, putting in these lower time frame demand ranges at present signifies to us that we're putting in the complex pullback to this overall supply range right here, because we can see that this is the lower high, this is the lower low. We still have an expectation to see a new lower high in the market before we see a new lower low, okay? And we do not assume structure. So once we've now come up, and as we can see, this is why it's so important to be able to read and understand structure from a fractal level, because we can see now this is where that sort of miscommunication of people not knowing, you know, even though we've had H4 and M15 realign, it doesn't mean we're going to hit the moon, because we need to understand and read the swing structures that we've got internally and the external structures as well. So now, as we can see here, what can we see? Right, so we've had this lower high, lower low, lower high, lower low, and we've just had a new higher high put into the market, okay? The actual larger swing structure, now you can see this supply range here from the high to the low. Then we've then created a new supply range. When we've broken this internal break, it's the highest point that's led to the break. Then we can see we've had this high to the low. Okay, that's created this new supply range. So now what we can see is we've now took this low, had an internal break bearish, and then we've had an internal break bullish. So now what we've had is we've now had an understanding that we've had a breaker structure bullish internally on the larger scale swing structures, which has now taken this high, and we've now shifted from supply to demand ranges on the bigger picture scale. So if we have a look at the larger swings with the supply ranges, we can see lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, higher high. So we can see now internally we've shifted from these supply ranges to demand ranges. So now what can we see? We can see we've now had the higher time frame demand range following this breaker structure here, this low to this high. We've then had internal structure from the higher time frames perspective, the low gone, and then the high gone. So now we've had structural alignment occur. So we've had the internal structures realign with the swing structure, which can now potentially mean that we can now see price come and target this high, because now what's happened is this becomes weak, and this becomes weak. Because what should happen if the expectation of swing structure is to fail, for example, if this low was to go, being the protected low, these ranges should hold until the swing structure goes, okay? But what's happened is the mitigations that we see, supply range mitigation, supply range mitigation, supply range mitigation, once the mitigation has failed and we've now started to put in these demand ranges, now what happens is these highs then become weak. So then we can target these and use these as partial targets, because we understand that all protected highs and lows become liquidity targets in the future. Okay, so now, for example, what we can see here is this would work the same thing as what we'd have here. We don't have true structural confirmation that we're going to come and take this high until this larger supply range has been broken, okay? Because what could potentially be happening here is we'd still have lower time frame swing structure like this, okay? And only until we've then taken this high does that give us true structural confirmation for this swing structure to come and get taken, have this come and get ran, because we understand internally that now what we've had is we've had that shift from supply ranges to demand ranges from that larger swing structure scale. So we understand that what we can see is higher time frame to lower time frame ranges being formed, and we can use ranges to understand and see where we can potentially see price head next. So we can see this high to this low to this high being that 4-hour demand range, and as we can see here now, we can see demand range here internally, new higher high, higher low, okay, and then the new higher high. And then, for example, here now on the lower time frame, such as the 1 hour, we shift bearish, and then we can see the supply ranges being put into the market. We can see higher time frame supply range, higher time frame supply range, indicating the complex pullback to this overall larger bullish swing structure, and we can see we're contained within an overall demand range. And then what's happening here now is price is pulling back, putting in these supply ranges, and then as we get our mitigation to our valid demand level, we can see now once the swing structure internally, the higher time frame swing, has broken bullish, this is now given us structural alignment, because we can see that we've now put in a larger higher time frame demand range, that is in line with this higher time frame demand range. So now we've had structural alignment. So what should happen once you've had structural alignment occur and all your swings are aligned? These supply or demand ranges should hold until the structural expectation fails, for example. So if we have a look now and we see we've had this new internal breaker structure bullish and we've had the mitigation into these demand ranges, you can see now the demand ranges hold until the structural expectation comes and gets taken. So this is something that's really important to understand. When we've had true structural alignment and all our swing structures are aligned, we then have an expectation that these supply or demand ranges should hold until the swing structure comes and gets taken, which we can see here, okay? So once you've had that internal break bullish and then the supply ranges switch to demand ranges in this case, change, and they've realigned with the swing structure, this now should give us an indication that we can now come and see this come and get taken, and we can see now the ranges should hold until we come and take out the swing structural weak target, okay? So this is very similar to the whole internal structure versus swing structure, but the way in which we utilize this and use this when it comes to actually viewing structure is super important, and you'll see as we come into it later on how we're really going to utilize this. So what we're going to do now is just move on to the next part. So one of the next things that we really need to make sure that we're keeping into account and looking out for is when we can identify a potential supply or demand level to be deemed as weak. So what we can see here is we can see that we've got bullish market structure in terms of swing structure. We can see higher high, higher low, higher high, bullish market structure expectation, higher low before a new higher high, okay? That's nothing new. But what we can do is we can understand and use these supply and demand ranges to understand when potential levels can be deemed as weak and when they could potentially be held. So like we said before, when we've got swing structure, when we have an expectation and structure is aligned and potentially then seeing the swing structure to become and get taken and the expectation to fulfill itself, we expect to see these supply and demand ranges hold. But if we see these fail, what this can mean is the original mitigation that was the start of that potential, in this case higher low, could now be deemed as weak. So let me just explain this. So we understand here, we can see we have higher high, higher low, higher high. We have an expectation for a new higher low before a new higher high, okay? But now look at the internal structure. We can see we've had an internal structural break bearish and then an internal structural break bullish. So we've gone from this supply range to a larger demand range, okay? So now we've put in a new demand range in the market. So we've had an internal structural break bullish in line with the larger, higher time frame demand range also being bullish. So now we've had confirmation that we've now potentially got structural alignment occur. So what we understand is if structure is to fulfill itself and take this high, these internal demand ranges should not fail until the swing structure goes, okay? But what do we see? We put in a new higher high, we put in a new higher low. We can see there was a perfectly valid entry to take here, and then we put in a new higher high, okay? But what happens here? We can see we get a mitigation to supply, okay? And what is, if the structural expectation is to fulfill itself, what could we expect to see? A new higher low before a new higher high, because we understand that these highs are now protected when we have internal structural breaks bullish, okay? And these ranges should hold. But what's happened? Price then has mitigated supply and caused this demand range to fail. So what's happened? We've now put in new supply ranges in the market. So the demand ranges internally, being these here, failed to come and take the swing structure, because we can see here now we've broken bearish and put in a new supply range. So what this means now is, like we always say, old protected swing highs and lows become liquidity targets and weak highs and lows in the future. So we can see once we got this bearish breaker structure right here, this can now become weak, and now this original mitigation can now be deemed as weak, because this, if we would have followed through with the expectation and put in a new higher high, this would have become the protected high, okay? Sorry, the protected low, because it's the lowest point that leads to the breaker structure. But what can we see? We got the mitigation to demand. Price then started to put in the demand ranges, okay? And then what happened? The demand ranges failed to come and take the swing structure, and supply ranges structurally started getting put back into the market. So what can we see has happened? Price now has now put in new supply ranges, okay? Which is now coming and testing lower. And then we can see now this low can be deemed now as weak, which is what we can see now. Prices then come and mitigated into lower demand into here. The weak low came and got ran because the demand ranges failed. And then what do we see again? Now we've taken this low and now we've taken this high. We've gone from a new supply range into a demand range. So now we've then got realignment once again, because the structure, the swing structure being this low to this high, has not failed yet. We're still bullish. That is still the structural expectation. Then what can we see? Prices then come down and mitigated into the demand. We can see the lower time frame shift here, where we can see this low go and see this high go. But when we think of supply and demand ranges, when we've got a larger supply range that we're contained within, and then we get lower time frame change bullish, putting in demand ranges, this is currently now putting in a complex pullback to this overall bearish structure. And only until this supply range fails does that now confirm to us that we've had structural alignment, because all we've got now is demand ranges in the market. Okay, we've got the higher time frame demand range being this, and now internally we've now had this breaker structure bearish, which is now turned bullish here. So now we've got swing structures that are once again aligned. Okay, and as we can see in this example, when we understand here, when we have these demand ranges, you can see, even though we are still contained within this overall bearish swing structure, we can see that what's the expectation of this? It's a new lower high before new lower low. But what can we see? We can see when we shift to these demand ranges, we get this demand range, expansion out, price pulls back, mitigation, and we can see these demand ranges hold until this supply range goes, because the higher time frame intentions was that we are expecting to see a new higher high in the market, okay? So we never assume structure, okay? We just adapt and read what price is telling us. So for example, if we would have got a mitigation into supply here, for example, okay? Let's just say we get a mitigation to supply here. And then what happens? We get a new demand range, okay? But then what happens? This demand range, let's say it came up, okay? But then it actually failed and came and tested lower. Now what this means is that we've now shifted from, it'd be from this low right here. You shift that one there. So if this low now went, what this means is now we've now put in a new larger supply range, being this right here. Once we get this internal break here, we've now got a new supply range in line with this swing structural supply range. So now potentially now we could now come and see this get ran. but this is where we need to understand the bigger picture and still understand the structure we're contained within. Okay, so then what we need to understand also is this is where we need to be a little bit more aggressive potentially, and this is how I sort of trade. When we come and mitigate into an extreme level, we understand that if we mitigate an extreme such as this, okay, so let's just say this is mitigated the last valid demand level in this case. When we mitigate an extreme, this is the last structural point that we can expect to see price go to fulfill its structural expectation. So when we see higher high, higher low, higher high, we have an expectation to see a new higher low before a new higher high. And we do not have an expectation to see this protected low get ran. Only until the protected level goes does this then signify that we've had a change in trend. Okay, but we understand that anything contained within this range is completely valid to look to long from. Okay, and we understand that following normal structure, we do not have an expectation to see this low get ran because it is protected. So when price comes and mitigates an extreme, this is where we can be a little bit more aggressive because we understand that, for example, if we were taking a long in this position here, right, okay, and price, we took a long here, we need to understand that if we got, for example, a lower time frame shift here and we started to trade up, we are still contained within an overall bearish swing structure internally. So there's still every reason price could potentially come and test lower into lower demand, okay, because internally we're still contained with an overall bearish swing structure being this supply range right here. Okay, so we understand if we're looking to take longs here, which we'd be very cautious of doing anyway, because we understand that this is a weak low because obviously the demand ranges failed to come and take the swing. So once we got this internal break bearish, this now became weak. So we'd be very cautious of long in here anyway, but if we were, we'd understand that we still have internally, we're still contained within this bearish swing structure right here. This bearish swing structure has an expectation at present, understanding swings. This is protected, this is weak. We still have an expectation to see a new lower high before a new lower low. So we can't confirm structural alignment until this high would have gone, because then that would have then given us a new demand range in the market, which is in line with the whole higher time frame demand range being this, and then we can potentially then come and see this get ran. But what we need to understand about extremes is extremes are the last point that we can expect to see a structural expectation fulfill itself. So in this case, we can see higher high, higher low, higher high. When price comes down and mitigates this demand at the extreme, this is the last point price can go to before price can continue on its expectation. So we can be a lot more aggressive here with our management, for example, because what we understand is if this mitigation to this demand level here at the extreme is going to fulfill the expectation to put in a new structural higher high, this internal, like this protected high internally should go, because think swing structure is the most important thing and everything else internally is just lower time frame swing structure. So if this is to hold, this extreme here has to be the last place price can come and put up this higher high. Okay, so when we get this change of character at the extreme and we've then gone from a lower time frame from supply to demand ranges, if we catch this trade here, we can be more aggressive with the management because we understand we've mitigated an extreme, because if price is going to continue bullish, we should not see this low get ran. Okay, so there's no other place lower price can come to unless then the structural expectation shifts bearish and we get a breaker structure bearish, but then that changes our narrative. So what we understand compared to taking longs in the middle of structure, if we take an extreme trade, for example, we can be a lot more aggressive because we understand that this is the structural expectation, higher high, higher low, higher high. We've mitigated the last demand point that price physically can go to. So when we see this shift from supply to demand ranges and we want to catch that trade, even though we are contained internally within a bearish swing structure and it's this whole overall supply range, it does not matter, and we understand you still want to be cautious, but because we've mitigated an extreme, there should be, we could in theory now, like we said, we don't assume structure, but we understand the possibilities and the logic behind it, that if we've mitigated an extreme and this is the expectation to get ran, and we've mitigated that last point, then this high should in theory come and get ran. Okay, so if you want to take partials at supply levels, understanding you're still bearish, you can do, but think of the bigger picture. We are still overall bearish. We have an expectation for a new higher high. So this is what we need to understand. And then as we then see, we take this low, we take this high. Once this internal supply range has then shifted to a higher time frame demand range, because we can see we had this internal break bearish and then we get this internal break bullish. We have now had structural alignment occur once again after taking the week low. And once again, what do we expect to see? If now we've had true structural alignment because we've got the higher time frame demand range, and then internally now we've got these larger demand ranges internally. Now these ranges should hold until the swing structure comes and gets taken. Okay, so now think about this, and this is why it's so important to just understand structure through a series of ranges and understand the logic behind what's going on. So for example, if we mitigate this now, okay, this supply level, and we start putting in supply ranges like so we come up and we start putting in supply ranges, we need to think about the logic behind price turning bearish here. It's not because we expect this to come and get ran. We understand that on a lower time frame, for example, now we've had higher time frame swing being this, and internal structure, which is like that 1 hour, also shift bullish. Okay, this is given a structural alignment. So when we have a breaker structure bearish and a breaker structure bullish to bearish, and we then shift from demand to supply ranges on a lower time frame, this signifies to us that all we are doing is putting in a complex pullback to this overall bullish structure. So we can see then we're contained within this whole overall bullish structure. Then when price starts to pull back, okay, and we start putting in supply ranges like so, we can see supply range. Okay, let's just bring price down again. Okay, and then when we get this, and we have this supply range, and then price then, after mitigating valid demand, like so, and we can see that this, for example, would look like the flip zone, and we can see it's the last unmitigated range within the level. We can see then, as price is putting in supply ranges to put in the complex pullback, as soon as we now mitigate valid demand and structurally, we now see demand ranges being put into the market. What's this showing again? We've now had structural alignment occur again. So we can see that despite us now being the external structure being bullish, being this whole larger demand range, and then internally, we've now put in a larger demand range internally, being that 1 hour structure. And now once we've 15 minutes starts going bearish, which is these supply ranges, once now we've shifted from bearish to bullish here, and we've now put in a demand range in line with this larger demand range, this is your trade that you are now going to hold to full volume pretty much, or it's valid to come and target this high, because now you've had true structural alignment occur in the market because all your swing structures are aligned. So the difference between taking this is we understand that we were still contained internally within a bearish swing structure. But once we got this breaker structure here now, we had now structural alignment occur. And we just have to think about when we see these supply and demand ranges, what do they mean? Okay, so this is what is so important to understand, and we're going to go into it again a lot more in detail as we go into the application behind using this on the charts and how we can potentially look at this to understand structure from this fractal understanding. So what we're going to do now is head over to the next section.